Did you know that you can transform a humble $100 into a cool $10,000? We'll break down everything step by step, from opening your first brokerage account to mastering the art of smart strategic investments. So buckle up, hit that subscribe button, and let's unlock your financial freedom. Alright, so you're ready to start investing? That's amazing. It's a big step towards securing your financial future and building wealth over time. The first step is to open a brokerage account. This account will be your primary tool for buying and selling investments. Think of this like your gateway to the stock market. It's where all your investment activities will take place. Now, there are tons of different brokerage platforms out there, so it's important to do your research and find one that aligns with your needs. Look for features like low fees, user-friendly interfaces, and good customer support. Some popular options include Fidelity, Vanguard, and M1 Finance. These platforms are well regarded and offer a range of services to help you get started. Each has its own unique features and benefits, so take some time to compare and choose the one that's right for you. Consider what kind of investor you want to be and what tools you'll need. Once you've got your brokerage account set up, it's time to start thinking about the types of investments you want to make. This is where your financial goals and risk tolerance come into play. There are stocks, bonds, mutual funds, ETFs, and a whole bunch of other options. Each type of investment has its own risk and return profile. The important thing is to start exploring and learning about the different ways you can put your money to work. Education is key to making informed decisions. Remember, investing is a journey, not a race. Take your time, stay informed, and enjoy the process of growing your wealth. Okay, before we dive into specific investment strategies, there's one crucial rule you need to understand. Only invest what you're willing to lose. Investing always involves some level of risk. The market can be unpredictable, and there's always a chance you could lose some or even all of your investment. Never invest money that you need for essential expenses like rent, groceries, or bills. It's also crucial to have an emergency fund in place before you even think about investing. By having that emergency fund, you'll be in a much better position to weather any financial storms that come your way without having to touch your investments. Remember, investing is a long-term game. So start small, be patient, and don't let fear hold you back from taking that first step. Before you start throwing money at the stock market, it's crucial to define your financial goals. What are you ultimately saving and investing for? Are you dreaming of buying your dream home? Retiring early and traveling the world? Or maybe you simply want to achieve financial independence and have the freedom to pursue your passions. Instead of saying, "I want to be rich," try something like, "I want to save $1 million for retirement by age 50. Having clear goals will not only give you direction and motivation, but it will also help you determine the right investment strategy to get you there. Remember, your financial goals are unique to you. Always remember to educate yourself. The world of investing can seem complex and intimidating, but knowledge is power. The more you learn about investing, the more confident and successful you'll become. Fortunately, there are tons of resources available to help you expand your financial literacy. You can find a wealth of information online, from reputable websites and blogs to educational YouTube channels like, well, this one. By dedicating time to educate yourself, you'll be better equipped to make informed decisions and navigate the ups and downs of the market with confidence. Think about starting with low-cost index funds. When you're just starting out, one of the best ways to invest is through low-cost index funds. An index fund is essentially a basket of stocks or bonds that tracks a specific market index, like the S&P 500 or the Dow Jones Industrial Average. Instead of trying to pick individual stocks, which can be risky and time-consuming, index funds allow you to invest in a diversified portfolio of companies with just one purchase. One of the biggest advantages of index funds is their low fees. Traditional mutual funds often charge high expense ratios, which can eat into your returns over time. Index funds, on the other hand, typically have much lower expense ratios, meaning more of your money is working for you. Diversify your portfolio. You know what they say, don't put all your eggs in one basket. This couldn't be more true when it comes to investing. Diversification is all about spreading your money across different asset classes, industries, and geographical regions. This helps to reduce your overall risk by ensuring that if one investment performs poorly, it won't significantly impact your entire portfolio. Instead, by diversifying your portfolio, you're essentially hedging your bets and creating a more resilient investment strategy. So, how do you diversify effectively? One way is to invest in a mix of stocks, bonds, and real estate. You can also consider investing in international markets to broaden your horizons and potentially tap into growth opportunities outside of your home country. Keep your eyes on the fees. Fees can be a silent killer of your investment returns. You might not think much of a 1% expense ratio here or a $5 trading fee there, but over time those costs can add up and significantly erode your profits. When evaluating investment options, pay close attention to expense ratios, trading commissions, and any other hidden fees. Remember, every dollar you save on fees is a dollar that can be invested and potentially grow over time. So be fee conscious and make sure your hard-earned money is working as hard as it can for you. Stay consistent with your investing goals. The key to successful investing is consistency. It's not about timing the market or trying to predict the next big winner, but rather about consistently investing over time, regardless of market fluctuations. By starting early and staying invested for the long term, you give your money more time to grow and compound. Even if you can only invest a small amount each month, the power of compound interest can work wonders over time. Compound interest is essentially earning interest on your interest. So instead of trying to get rich quick, focus on developing a consistent investment habit. By making investing a regular part of your financial routine, you'll be amazed at the progress you can make over time. Always monitor your investments. Investing isn't a set it and forget it kind of deal. It's essential to regularly monitor your investments and make adjustments as needed to ensure you're on track to achieve your financial goals. This doesn't mean you need to obsessively check your portfolio every day. Instead, aim to review your investments at least once a quarter or semi-annually. Life happens, and your financial circumstances and goals may change over time. By actively monitoring your investments and making informed adjustments along the way, you'll be better equipped to navigate market fluctuations and stay on course to reach your financial destination. Avoid emotional investing. Investing can be an emotional roller coaster with its ups and downs that can make even the most seasoned investors feel uneasy. When the market is soaring, it's easy to get caught up in the hype and make impulsive decisions based on greed or fear of missing out. This can lead to buying high and regretting it later. On the other hand, when the market takes a downturn, it's natural to feel anxious or panicked, leading to rash decisions driven by fear. Selling in a panic can lock in losses. The problem is that emotional investing rarely ends well. It often results in buying high and selling low, which is the opposite of a successful strategy. Instead of reacting to market swings with your heart, strive to make rational, data-driven decisions based on your investment plan and long-term goals. This approach helps you stay grounded. The key is to stay the course, stick to your investment strategy, and avoid making impulsive moves based on short-term market fluctuations. Consistency is crucial. If you find yourself feeling overwhelmed or emotional about your investments, it's always a good idea to take a step back, breathe, and seek guidance from a trusted financial advisor. They can provide an objective perspective. Reinvest your earnings. One of the most powerful ways to accelerate your wealth-building journey is to reinvest your earnings. By doing so, you allow your investments to grow exponentially over time. When you reinvest your dividends, interest payments, or capital gains, you're essentially buying more of the same asset, which generates even more earnings over time. This compounding effect can significantly boost your overall returns. Think of it like a snowball rolling down a hill. As it rolls, it picks up more snow and grows larger and larger. Reinvesting your earnings is like adding more snow to that snowball. The more you add, the bigger it gets and the faster it grows. Many brokerage accounts offer dividend reinvestment plans, or DRIPs, which automatically reinvest your dividends back into the same stock or fund. This makes the process seamless and efficient. Even if you don't have a DRIP set up, make it a habit to reinvest any earnings you receive from your investments. This proactive approach ensures that your money is always working for you. Whether it's dividends, interest, or capital gains, put that money back to work for you and watch your wealth snowball over time. Consistent reinvestment can lead to substantial growth in your investment portfolio. Seek professional advice. While there's a wealth of information available online, sometimes it's beneficial to seek personalized advice from a qualified financial advisor. A financial advisor can help you create a tailored investment plan based on your specific financial situation, goals, risk tolerance, and time horizon. When choosing a financial advisor, it's important to find someone you trust, who understands your needs and who acts in your best interest. Look for advisors who are fiduciaries, meaning they're legally obligated to put your interests ahead of their own. A financial advisor can be a valuable resource and partner on your journey to financial success. Start building your $10,000 portfolio today. There you have it. You now have the knowledge and tools to turn that $100 into $10,000 and beyond. Remember, investing is a marathon, not a sprint. It's about making smart, informed decisions, staying consistent, and letting the power of compound interest work its magic over time. The most important thing is to start now and stay committed to your financial goals. So, what are you waiting for? Open that brokerage account, start investing, and watch your money grow.